Imagine this. You're 25 years old. You're healthy, you exercise, you eat well, and it feels like your whole life is ahead of you. Then one day you start a new job. You're filling out the usual paperwork when someone asks you a strange question. Would you like to enroll in life insurance? For a second you stop and think. Life insurance? You're not planning to die anytime soon, so why are they already asking about it? Now here's an even stranger question. If insurance companies promise to pay your family hundreds of thousands, sometimes even millions of dollars, how do they stay in business? Shouldn't they eventually run out of money? After all, everyone dies eventually. So how can a business built around death become one of the biggest financial industries on earth? The answer isn't luck. It isn't greed. And it definitely isn't magic. It's mathematics. Once you understand how it really works, you'll never look at life insurance the same way again, because the biggest product insurance companies sell isn't actually insurance. It's something much more valuable. Time. Life insurance didn't begin in a modern office. It actually began hundreds of years ago with ships. Back then, sending a ship across the ocean was incredibly risky. Storms, pirates, disease. A single voyage could wipe out someone's entire fortune. So merchants came up with a simple idea. Instead of one person carrying all the risk, everyone would contribute a little money into a shared pool. If one ship sank, that pool would help cover the loss. It was a surprisingly simple solution. Share the risk. So one tragedy wouldn't destroy a family or a business. Years later, someone asked an interesting question. If we can insure ships, why can't we insure lives? And just like that, life insurance was born. At first, many people thought the idea was strange. Some even believed it was immoral. How could anyone possibly put a price on a human life? But over time, people began to see it differently. Life insurance wasn't really about predicting death. It was about protecting the people left behind. If a parent died unexpectedly, the mortgage could still be paid. Children could stay in school. Life could continue. That's why millions of families chose to buy it. Not because they expected the worst, but because they hoped for the best. But here's the mystery. If insurance companies collect money from millions of people and eventually have to pay enormous claims, where does the profit actually come from? The answer is surprisingly simple. Imagine a town with 1,000 families. Every month, each family contributes a small amount of money, not because they expect something terrible to happen, but because they understand that life is unpredictable. Now imagine that during the entire year, only a handful of those families actually need financial help. The money collected from everyone helps support the few who need it most. That's the basic idea behind insurance. It's called risk pooling. No one knows exactly who will need help. But when you have millions of customers, companies can make remarkably accurate predictions about how many claims they'll receive over time. And they don't make those predictions by guessing. They rely on mathematics, historical data, health statistics, life expectancy, and even advances in medicine. Entire teams of specialists called actuaries spend their careers calculating risk. Their job isn't to predict one person's future. It's to understand patterns across millions of lives. Now here's where the business becomes really fascinating. Insurance companies don't simply collect your monthly premium and leave it sitting in a bank account. That money is invested in government bonds, businesses, infrastructure, and other long-term investments. While most policyholders continue living their everyday lives, those investments continue growing. Years pass, sometimes even decades, and during that time, only a portion of customers make claims. That combination of careful risk management, long-term investing, and the value of time is what allows the entire industry to operate. So, does that mean life insurance companies want people to die? Not at all. In reality, the business works best when people live long, healthy lives. Longer lives often mean more years of premiums, better investment returns, and fewer unexpected claims. Their business isn't built around death, it's built around managing uncertainty. And maybe that's the most surprising part of this entire story. The product was never really about death. It was always about protecting the people who keep living. Behind every insurance policy is a family hoping they'll never need it, a parent looking for peace of mind, a child whose future might depend on a decision made today, a promise made now, for a day everyone hopes never comes. And that's how one simple idea, sharing risk to protect one another, grew into one of the world's largest financial industries. If this story changed the way you think about everyday businesses, you're going to enjoy what's coming next, because some of the biggest industries in the world aren't built on products. They're built on ideas that most of us never stop to question.